All right, so here you can see an example, and we're going to use this information for all three methods. So we're going to look at this truck and amortize it under the three different methods. So we're assuming a truck was purchased on January 1st, 2020, and the year end of the business is December 31st. The truck had a cost of $65,000. The estimated residual value is $5,000. And this is just calculating the amortizable cost. So cost minus estimated residual value equals that amortizable cost of $60,000. Now for the estimated useful life, we're going to use only part of this for each of the different methods. So they think the truck will either last 5 years or 400,000 units. So in this case, kilometers. So we'll use that for units of production method. And then this bottom information is just the details that we'll need for units of production. We are going to start with using the straight line amortization method. So this should be a review because this is what we did earlier when we looked at in adjusting entries and we booked amortization. We used the straight line. So as a reminder, the straight line amortization expense that is calculated as our cost minus our residual value. So that's that amortizable cost. And we divide it by the useful life in years. So if we're using the straight line method, we're not worrying about units of production or these kilometers. We just care about the number of years. So for our example, cost is $65,000, residual value $5,000, and it's an estimated life of 5 years. So we can calculate this. Cost of $65,000 minus $5,000, and we divide that by 5 years. So what do you get as our amortization expense per year? So 60,000 divided by 5, we end up with $12,000 per year. So for the straight line, it's the same every single year. So at the end of 2020, 2021, 2022, all of the years up to 5 years, we are going to record amortization expense of $12,000. Okay, so here, if we want to record, so this is 2020. On December 31st, 2020, we get to the end of this first year, we need to record the expense. So we're going to debit amortization expense and remember that we credit accumulated amortization for the truck. So we're not actually adjusting the value of the truck. We leave the truck account at that full amount. We keep it at its cost. We use the contra account for this accumulated amortization and we record it there. So just as a reminder, this is that contra asset account. So it sits on the balance sheet with the truck account and we just net them together to get that book value, which is the net amount. But users want to know what you originally paid for the truck. So we leave that a balance as it is at the $65,000 and use this separate contra account. Okay, so this is what we've looked at so far. We've just looked at how you determine 1 year. But we actually want to now be able to look at amortization over the life of the asset. So for the full 5 years. So your textbook gives you a chart that you can use, and we'll go through that in a minute. But I want to think about this in our T account format that we've looked at so far. So we can think about the 2 T accounts that are involved. We have our truck account, And we know from here it cost $65,000. So when we booked that purchase, we would have debited the truck for $65,000, credited cash. So at the purchase time, that truck is sitting there for $65,000. And now we're also going to track the accumulated amortization for the truck. So when we purchase it, there's zero amortization. So on January 1st, 2020, when we bought the truck, so this is at the purchase time, it's sitting at this cost of $65,000. There's no accumulated amortization. So we can also calculate our book value, which is the cost minus accumulated amortization. So at the purchase date, our book value is that full $65,000. Now we can go through and see what it would look like every year when we book the amortization expense. So we saw here on December 31st, 2020, we would debit amortization expense, credit the accumulated amortization. So a T account for the expense, I'm not going to do it, but remember that that would get reset every year. It would get closed into retained earnings. So each year, at the end of the year, it would be $12,000 and then it would get closed. Whereas for our accumulated, this is the one where it continues on for the life of the asset. So in the first year, as we saw here, we had a credit to the accumulated amortization truck of $12,000. So we book that $12,000 and we can calculate that at the end of year one, our accumulated amortization is at $12,000. We can figure out the book value, our cost of $65,000 minus this new balance of $12,000, and our book value is equal to $53,000. So a question that you could get, it could ask you, what is the accumulated amortization after year one? Or maybe it says, what's the amortization expense in year one? Or what's the book value after year one? So that's why I'm showing you all of these different calculations, because the question could ask you for different pieces of information. At the end of December or of 2021, again, we would now record this same journal entry because we're using the same dollar value each year. So at December 31st, 2021, we would book another $12,000 of amortization expense and book it to the accumulated. So at the end of year two, we now have this accumulated amount of $24,000. So our book value here, the cost of $65,000 minus $24,000, our book value is $41,000 at this point. And we continue this on each year. So go ahead, you can pause the video or just try it on your own to see what you can get to. And I'm just going to fill this in as we go. Okay, so now I'm getting to the end of year 5. And at this point, my accumulated amortization is $60,000 and my book value is $5,000. So this is where we stop. And the reason we stop here, well, twofold, is first, our estimated useful life for the truck was 5 years. So that's where we're going to stop because we've amortized it over that useful life. But more importantly, you stop amortizing when your book value of the asset gets to the residual value. So you can see that here. So at this point, we've got to $5,000, and this equals our estimated residual value. So that's where we always stop amortizing, regardless of the method. So even if, let's say, we estimated wrong and we still use the truck for another 2 years, we just don't record any more amortization at that point. We stop because we think we're going to get this $5,000 once we're able to dispose of the truck. So that's the cost that we want to remain there. That's the value we think we're going to get. So the straight line method, you automatically stop there at the end of year 5 because you're doing this equal amount every single year. So basically at the end of the useful life, or your estimated useful life, you stop amortizing it, even if you're going to continue on and use it for more years. Okay, so that's the straight line method. It's the easiest because it's the same dollar value each year. In the next video, we will look at the units of production. Actually, before we move on to the next video, I want to note quickly and go through this chart that the textbook gives you. And this is another way that you can use, and it gets you the same results. It's just doing it in a different format. So I showed this T account method just because we've talked about T accounts. So I like the way that it shows what's in the truck account, shows what's in the accumulated. But you're welcome to also use this method. So now, instead of figuring out the 12,000, I mean, you could do that, but it looks at what's called this amortization rate, or the straight line rate. And this is multiplied by our amortizable cost. So your straight line rate is equal to 1 divided by the estimated useful life in years. Whoops. Useful life. I combined it, but you guys can write useful life in years. So for our question, it was 1 divided by 5 years. And then you can see here that you multiply that by the amortizable cost. So it's the same thing that we did in our calculation here. It's just writing the formula in a different way. So you take the 1 out of 5 times 60,000 gets us your amortization expense each year. And then you're just figuring out your accumulated. So it's basically what was the opening plus what you just booked gets you to your new amount. And then the book value, sorry, this is kind of formatted weird. The book value is your cost minus the accumulated amortization. So we know our cost is 65,000 minus 12,000 gets you the 53. So you just continue that each year. So for the accumulated in this case, we take, or in year 2, take 12,000 plus the 12,000 gets you to 24. And then the book value, again, you're 65 minus that 24. So just a different format. Either one will work well. Okay, so now that we've seen this, in the next video, we'll go through the units of production.